Welcome to the Opening Bell Report.
Okay, so I was staring at my screen yesterday, trying to make sense of the market, and I saw something that it just didn't compute. You know those days where a stock chart doesn't look like a chart anymore? It just looks like a mistake.
Like a glitch in the matrix.
Exactly like a glitch. I'm looking at Richtech Robotics, ticker symbol RR. For months, this thing has just been chopping along. And then, out of absolutely nowhere, boom, a vertical green line.
Not a gentle slope.
No, not at all. We are talking about a rip from $4.21 all the way up to $5.60 in a single session. That is a 45% move.
It creates that feeling of immediate panic and curiosity, doesn't it? You spill your coffee wondering if you missed the news of the century.
That's the thing. I checked the volume immediately, because price is one thing, but volume, it tells you if people actually care. And the volume was absolutely screaming. 126 million shares traded.
Which is massive. It's not just massive. It's 3 times their average. It's like the entire population of a small country decided to buy this one robotic stock on a random Tuesday. So the question on everyone's mind, and certainly on mine, is simply why?
Right.
Is this just a classic pump? Is it internet hype? Or is there something actually substantial under the hood here?
It's the million-dollar question.
Right.
And we have this analysis report in front of us, and what's so fascinating is that it paints a picture of 2 completely different realities just colliding at once.
Okay.
You have the story of the squeeze, the mechanics, the trading loops, all the technicals, and then you have the story of the business itself.
And usually when a stock rips 45% in a day, those 2 stories are in a fist fight.
They absolutely are.
Huh?
Our mission for this deep dive is to referee that fight.
Yeah.
We need to parse through this report to separate the gamma squeeze metrics, which look explosive, from the fundamental reality, which is, well, let's just say it's complicated. Complicated is a very polite way to put it, based on what I'm seeing in the risk section later on. But let's start with the spark. You don't get 126 million shares trading without a headline.
No, you don't.
And the report points the finger squarely at one name: Microsoft.
It's the ultimate buzzword right now. On January 27, 2026, Richtech announced they are collaborating with Microsoft's AI Co-Innovation Labs.
See, whenever I hear Co-Innovation Lab, I get a little skeptical. It sounds like a corporate retreat where people stick Post-it notes on a whiteboard.
Yeah, that's fair.
Really?
But the report suggests this is actually a pretty deep technical integration.
Okay.
It's deeper than a whiteboard session.
Yeah.
The analysis details that this partnership is specifically about integrating Microsoft's Azure AI into Richtech's humanoid robot, which they call Adam.
Adam, they really want us to feel for this
Yeah,
robot.
they do. But the integration is the key here. They are upgrading Adam with something called agentic AI.
Okay, stop right there. Agentic AI. I feel like every week there's a new flavor of AI.
Yeah.
We had generative AI, now we have agentic. The report tosses this term around quite a bit. What is the actual difference? Is it just a smarter chatbot inside a metal head?
No, it's a functional leap. I mean, think of it this way. Imagine you're at a coffee shop. A standard robot arm, the kind we've had for decades, is programmed to pour coffee into a cup at coordinates X, Y, and Z.
It's just following a script.
Exactly, a script.
Right.
If someone moves the cup 2 inches to the left, the robot doesn't know. It pours the scalding hot coffee onto the table because the script says, pour here.
It has no awareness, it's just following a recipe.
Precisely. Now, agentic AI, which implies agency, gives the robot the ability to reason and observe. An agentic Adam robot uses vision to look at the table. It sees the cup has moved. It reasons, I need to pour liquid into the vessel, not the table. It adjusts its arm and pours into the cup.
So it's not just following instructions, it's making real-time decisions based on the environment.
Correct. It covers vision, voice, and reasoning. So by plugging Azure's brain into Adam's body, Microsoft is theoretically giving Richtech's hardware the ability to think in a messy, real-world environment.
That makes sense why the market freaked out then. Because hardware is hard. Hardware is capital intensive and low margin. But if you turn a machinery company into an AI software company that just happens to have a robot body.
You hit the nail on the head. That is the re-rating. The market hates low-margin machinery stocks. It loves high-margin AI stories. Investors looked at this news and said, wait, this isn't a boring robot assembly stock anymore. This is an AI application play. And AI plays get much, much higher valuation multiples.
So it's an identity crisis that pays off. Yesterday they were a toaster manufacturer. Today they are a tech darling.
That is the narrative shift. And in this market, narrative drives liquidity.
But narrative alone usually doesn't cause that vertical line on the chart. You need something stickier. The analysis mentions a bonus catalyst that I found really interesting. It's not about the tech. It's about who owns the stock.
Right, the institutional validation. The report highlights a filing showing BlackRock has a 7.1% stake in the company.
BlackRock, the heavyweight champion of the world.
The biggest money manager on the planet. They hold about 11.2 million shares.
Now, I want to clarify something here. Does this mean Larry Fink sat down, looked at the Atom robot, and said, we need to own this? Or is this more mechanical?
That's a crucial distinction. The report calls it a passive stake. So in all likelihood, BlackRock holds these shares because Rich Tech is part of an index like the Russell 2000 or a robotics ETF.
Right.
When you buy an ETF, BlackRock has to buy the underlying stocks to match the index. They aren't necessarily making a qualitative judgment on the robot.
Okay, so they are forced buyers in a way. But why does that matter for the squeeze? If they are just passive holders, how does that help the stock price explode?
It's all about supply. We call it the float. If BlackRock owns 7% of the company in a passive ETF structure, they aren't day trading. They aren't selling those shares just because the price jumped 20% this morning.
They're sticky holders.
Very sticky.
Ah, I see. So those 11.2 million shares are essentially locked in a vault. They are off the market.
Exactly. So when demand spikes because of the Microsoft news, there are fewer shares available for everyone else to buy because BlackRock is just sitting on a huge chunk.
Lower supply plus higher demand equals price explosion. It's a supply shock.
It is. And for the retail investor, they don't care about the nuance of ETFs. They just see BlackRock owns 7% and view it as a stamp of legitimacy.
A psychological safety net. If the smart money is in, I'm safe to buy.
Okay, so we have the narrative fuel Microsoft. We have the supply constraint BlackRock. But then the report shifts gears entirely. It goes into the mechanics. And this is where it stops being about robots and starts being about pure math.
Yes, the gamma squeeze.
This is the engine room. This is where that 45% move actually comes from. The news lights the fuse, but the market structure is the dynamite.
Let's look at the short interest first. The report says it's at 23% of the float, which is incredibly high. I always hear high short interest, but what's the threshold? At what point do the alarm bells ring for the short sellers?
I'd say anything above 10% is notable. Above 20% represents a very, very crowded trade. It means nearly 1 out of every 4 shares available for trading has been borrowed and sold by someone betting the price will go down.
So the bears were piling in. They were convinced the stock was going lower.
They were confident. And the days to cover metric is vital here. Before this volume spike, trading was thin. It would have taken those bears days, maybe even a week, to buy back all those shares without moving the price.
It's like trying to evacuate a stadium through a single turnstile.
And then the Microsoft news drops, the stadium catches fire, and everyone rushes the turnstile at once. But that's a standard short squeeze. The report specifies this is a gamma squeeze. That is a different beast entirely.
Okay, gamma. This is where things get wonky. This involved the options market. The report says 161,000 call options were bought. Explain this dynamic to me like I'm 5. Who is on the other side of those bets?
Okay, so you go out and buy a call option because you think the stock is going up. A market maker, usually a computer algorithm at a big bank, sells you that option. They are the bookie.
Right, but the bookie doesn't want to lose money.
Correct. Market makers want to be neutral. They make money on fees, not gambling. If they sell you a call option and the stock price skyrockets, they are on the hook to pay you. They have short gamma exposure.
So they have to protect themselves.
To protect themselves, the moment they sell you that option, their algorithm automatically turns around and buys the underlying stock.
So I buy an option, and the bank's computer instantly buys the stock to hedge.
Yes. Now imagine 161,000 contracts being bought in a frenzy. That triggers a massive wave of automated stock buying by the market makers.
Which pushes the price up.
Right. And here is the feedback loop mentioned in the report. As the price goes up, the market maker's risk exposure changes. They have to buy more stock to stay hedged at the higher price.
So price goes up, computers are forced to buy more, which pushes the price up further, and then the computers buy even more.
Exactly. It's a robotic feedback loop. It happens in milliseconds. And this is happening while the human short sellers are panicking and trying to cover their positions.
Wow.
You have algorithms chasing the price up for hedging and humans chasing the price up for survival.
That is a terrifying amount of buying pressure. No wonder the chart went vertical. It's not about the fundamental value of the robot anymore. It's about a liquidity crisis for anyone who isn't long.
That's the definition of a squeeze. The price completely detaches from reality because the mechanics of the market force it to.
Well, speaking of reality, let's invite the party pooper into the room.
Yeah.
The report has a section called the reality check. And frankly, after all that excitement about AI and squeezes, this part is pretty sobering.
It's the bucket of ice water. And any responsible investor needs to read this section twice. Because while the squeeze is real, the business fundamentals are ugly.
Ugly is a kind word. The report calls the company a cash incinerator.
It's a visceral description, isn't it? But the math backs it up. They highlight a specific metric. Rich Tech is spending $1.80 for every $1 they generate in revenue.
Wait, let's pause on that. For every dollar coming in the front door, nearly $2 are flying out the back door.
Correct. That is a negative margin that is just hard to sustain. They aren't just losing a little off the top. They are fundamentally spending double what they make.
And the net income figure listed is negative $15 million.
Right. Negative 15 million. Now, in the grand scheme of massive tech companies, that doesn't sound like much. But for a small cap company, that is a bleeding wound.
It raises the question of runway. How long can you keep the lights on burning cash at that rate?
That's the danger. And despite this cash incineration, the stock is now trading at 20 times sales.
20 times sales. Not profit, because there isn't any.
Exactly. A 20x sales multiple is priced for perfection. It's priced as if they are already a high-growth software company. But right now, they are a hardware company losing money.
So if you are buying shares at $5.60, you aren't paying for what the company is today. You are paying for a dream of what it might be in 3 years if the Microsoft deal works out perfectly.
You are buying the narrative. The report makes it clear. Investors buying now are ignoring the balance sheet in favor of the momentum. It's a classic case of FOMO overriding due diligence.
It's funny, isn't it? In the real world, if you told a bank, I lose $50 million a year and spend double what I make, they'd laugh you out of the building. But in the stock market, if you add, but I have agentic AI to that sentence, they throw money at you.
It's the exuberance of the cycle. But gravity always asserts itself eventually. A company cannot spend $1.80 to make $1 forever.
So let's look forward. We have this tension, the bullish squeeze mechanics versus the bearish financials. The report outlines future scenarios with some specific price levels. If I'm a listener watching this chart, what am I looking for?
The report breaks it down into a pretty clear trade setup. The line in the sand is $5.
$5. Why that number?
Well, it's a massive psychological level. Human beings love round numbers. But also, from a technical standpoint, that's likely where a lot of recent buyers have set their mental stop loss. The analysis says if RR holds above $5, the squeeze is still alive.
And if it holds, what's the upside target?
The next major resistance is the 52-week high at $7.43.
That'll be another huge leg up.
It would. And the report even hints at the blue sky scenario. If we break the 52-week high and the short sellers capitulate completely, double digits, $10 plus, isn't mathematically impossible given the float dynamics we discussed.
That's the to the moon case. But we have to talk about the bear case, the downside.
The downside is swift. If this was just a news pop and the excitement fades, the report warns about a gap fill.
Explain gap fill for those who don't stare at charts all day.
Sure. When the stock jumped from around 420 to open much higher, it left a gap on the chart where no trading occurred. Market theory suggests that price often likes to return to fill that empty space. So the danger zone is a slide right back down to $4.20.
So you could ride the elevator up, and if you aren't careful, take the shaft straight back down to where you started.
Exactly. And who is left holding the bag at 420? The retail investor who bought at 560 because they saw the Microsoft headline and didn't check the cash burn.
That's the risk profile. High risk, high reward. It feels more like a casino bet than an investment at this stage.
It is a momentum trade. The report is very clear on that. If you are playing this, you are trading the squeeze, not investing in a stable business.
There is also a strategic angle here that we touched on briefly before we started recording. If you are the CEO of RichTech and your stock just went up 45% on massive volume, what do you do?
Oh, that's the common move. If I'm the CFO, I am looking at that stock price and looking at my empty bank account, and I'm making a phone call to issue more shares.
An equity offering. Dilution.
Exactly. They need cash to survive. The best time to raise cash is when your stock price is high and liquidity is deep. They could sell millions of shares into this rally to fill their war chest.
Which would be good for the company's long-term survival, but terrible for the squeeze, right?
It would kill the squeeze instantly. It dumps a massive amount of new supply onto the market, breaking the supply constraint we talked about.
So that's the hidden trapdoor. You're betting on the squeeze, but the company might use the squeeze to pay its bills.
It's the paradox of these situations. The higher the price goes, the more likely the company is to sell stock, which in turn pushes the price down.
It's a fascinating game theory problem.
It really is.
So bringing this all together, we've got Microsoft providing the brain for the robot. We've got BlackRock locking up the supply. We've got algorithms chasing their own tails in a gamma squeeze. And underneath it all, a furnace burning cash.
That's the summary. It is a perfect storm of modern market mechanics.
I want to leave the listener with a final thought today. We often talk about efficient markets, the idea that the stock price reflects the true value of the company. But when you look at a situation like RR, where the price is being driven by options flow, squeezed shorts, and buzzwords, does the balance sheet even matter in the short term?
That's the question. Can momentum override gravity?
And more importantly, can a stock price go high enough, fast enough to actually save the fundamentals? If they raise cash at $10, suddenly the bankruptcy risk goes away and the dream becomes real. It's almost like the market can wish the company into existence.
Reflexivity at its finest. The price changes the reality.
Wild stuff. If you are watching RR, keep your eyes on that $5 level, watch the volume, and please, for the love of everything, remember that cash incinerator metric.
Don't get burned.
Thanks for diving in with us. We'll see you on the next one.
Don't forget to like, share, and subscribe for more.